everybody, and welcome again to another episode of the Prosperity Thrive Drive, where we thrive boldly and prosper fully. Before I proceed, allow me to appreciate every one of you that have subscribed, that has come back to this channel to watch another episode. All of you that have liked, commented on our videos, thank you so much. Let's continue to watch. Let's continue to share with people that we feel will benefit from these episodes, and let's keep thriving and prospering. Welcome to another episode, and in this episode, we'll be talking about loan interest rates, how they are calculated, the different calculation methods for the loans interest rates. So in this episode, we'll be comparing the fixed rate versus the reducing balance versus the amortization method. Do you know we can have two people, person A and person B, both take the same loan amount, let's say 100,000, both repay within the same repayment period, let's say 1 year. But at the end of that 1 year, the two will have repaid different amounts. This is because of the loan calculation method that each lender has applied. Let's get started. Most borrowers focus on the amount borrowed. They don't look at the loan interest. They don't look at the repayment period. They also don't look at how that interest is being calculated by the lender. Choosing the wrong interest calculation can cost you tens of thousands of excess interest. So it's very important to understand how your lender is calculating the interests. So all lenders, the banks, the SACCOs, the MFIs, the Shylocks, the mobile lenders, they all use different types of loan calculation. They all use different models of interest calculation. The first interest rate that we are going to look at is the flat rate or the fixed interest rates. So in this case, the interest is calculated once on the full principal amount, and this interest will not change throughout the repayment period. If you're repaying within 1 year, the interest will be the same. It is fixed and does not reduce as you pay the loan. So this one is common with mobile loans and Shylocks. Rarely will you get this with the banks, but you never know. Some banks may use this type of interest calculation. I will demonstrate on how the fixed interest or the flat rate is calculated, and we'll also compare with the other interest rates calculation so that we can see which is the most expensive and what you should be going for. So let's go ahead and do the demo. So in this case, as I've said, we'll use a constant amount of 100,000, a repayment period of 1 year, so that's 12 months, and an interest rate of 12%. So let's start. So here I have the 100,000 as my loan amount, repayment period in years, 1, number of payments per year, 12 payments per year, so every month. Then the interest rate will work with 1 for all, so we'll use 12%. And then the start date, you can put any date. Then so let's start with the flat rates, and we'll see how the flat rate interest model is calculated. So let's run these. As you can see, the total installment is fixed, is the same amount all through the loan period, the 12 months. The principal amount is also fixed. It does not reduce or increase. The interest amount is fixed at 1,000 every month for the rest of the period. So the total amount that you'll end up paying per month, interest plus the principal amount, will be 9,333. So there is a total interest and total loan amount payable at the end of the period. So you borrowed 100,000, but you'll end up paying in total 112,000 at the end of the 12 months, and the total interest that you'll have paid is 12,000. Yeah, so that's the flat rate method. And of course, this column shows the months for the repayment period. The next one is the amortization. And in this case, the principal amount and the interest amounts are combined so that you repay the same loan repayment amount every other month. However, in this case, the principal, as you continue paying, the principal amount will be increasing as the loan interest reduces. It's somehow similar to reducing balance, only that in the amortization case, the total amount that you're repaying is constant for all the months. But the principal amount that is used to reduce the loan is increasing as the interest is reducing. We'll see this clearly as I demonstrate on the Excel sheet. So the interest at the beginning of the repayment will be higher, but it will continue reducing as you repay the loan. Also for this case, if you pay lump sum amounts, depending with the lender, your interest for the following month will reduce based on the balance you'll have for the previous month. So the next one we'll look at is the amortization. Using the same amount, 100,000 as loan amount, 12 installments, that's 1 year, and annual interest rate of 12%. So as you can see, the installment amount does not change. It's 8,884. If you remember, for the flat rate, it was 9,333. But the principal amount keeps on changing. It keeps on increasing, but the interest keeps on reducing. So this is also the aspect of the reducing balance of the interest in the amortization method. So at the end of the period, you'll end up paying 6,618. And of course, the total amount, including the loan amount, you'll end up paying 106,618. So if you compare with the fixed rate, which was interest total of 12,000, so meaning you end up paying 112,000. So you can see the interest you pay on amortization method is almost half what you pay when using the fixed rate method. Let's look at the reducing balance method. For this one, the amount of interest reduces as you continue repaying the loan. So the interest for the following month is based on the balance of the previous month. So meaning, if you boost your loan repayments, if for example, you're supposed to pay 10,000 per month as the principal amount besides the interest. If you're required to pay 10,000 and this month you pay 20,000, it means the next month's interest will be lower than what you'd have expected to pay if you didn't boost the loan repayments. This interest rate calculation is very fair and it's very ideal for long-term loans. This interest rate calculation is mostly offered by SACCOs and banks depending on the loan that you take from these lenders. I'll be demonstrating on the reducing balance calculation, so we'll look at the screen and see the total amount of interest that we'll end up paying when repaying a loan using the reducing balance interest calculation. So as you can see, for the reducing balance method, the installment keeps on changing from the first month until the last month. So it goes on reducing. The principal amount does not change. It's the same throughout the period, but the interest keeps on reducing because the interest for the following month is based on this balance. So 1% per month because the annual rate is 12%. So that means 1% per month. So the interest keeps on reducing based on this balance. So that means if you repay a higher amount on the principal, this interest will be less. So let's say if for the first month, the principal you repay 10,000 instead of the 8,000, then the balance will be 90,000. So meaning the interest for the following month will be 900. That's 1% of the 90,000. So as you can see, the total amount that you'll have paid as interest will be 6,500, slightly lower than the amortization method, and in total 106,500. So as you can see, for the three models, the fixed rate is the most expensive, then the amortization, and then the reducing balance. This total amount also will be dependent on the repayment period. Let's say let's do for let's say 10 years. So 10 years means 120 months. Let's retain the interest rate. Let's look at the, let's move this to 1 million. So let's work with 1 million, repayment period of 10 years. The interest rate will remain at 12% per annum. And let's compare this one also. So for the reducing balance, we'll pay, so as you can see, the reducing balance, let's just look at the interest. We'll pay interest of 605,000. Imagine that. So the longer the loan period, the higher the interest that you'll pay. So let's change this and see. If we do amortization, we'll pay 721. You see the way it's changing? Then let's do flat rate. This one will be very high. You'll end up paying at total interest that is even more than the loan that you took. You'll end up paying 1.2 as the total interest. So it's very important to understand the interest model that the lender is using as you borrow the loan. I hope this has made it clear, and now we are more enlightened. And now we'll ask the right questions when we go to borrow a loan. So if you need this spreadsheet for your own calculation and referencing, ensure you have subscribed and you've liked this video, and just comment, please share the spreadsheet, and I'll share it with you. The next one is the compounded interest. This is rare, but is very possible. It's mainly possible also with the mobile loans and the Shylocks and all these unregulated lenders. So in this case, let's say you're supposed to repay this loan on a weekly basis. If this week you don't pay what you're supposed to pay, then the interest for this week will be added to the principal amount, and the next interest will be based on the principal amount plus the interest. That's the meaning of compounding. It's where you pay interest on interest that was accrued for the previous month. So for these types of loans, you end up paying a very high amount. The loan ends up being very costly, and it may affect your finances at the end of the day. So before you choose the right interest calculation model, you need to ask yourself, is this loan long-term or short-term? Do I need to have a definite amount that I'll be repaying every month? Are there benefits of repaying faster the loan? If I repay more than I am expected, will the interest for the following month reduce? And also, what's the total interest I'll pay at the end of the repayment period? So whenever you go to take a loan, always ask your lender the interest rate calculation that they are using for the loan that you're getting. Also ask about the total cost of that loan, because interest is just one of the costs of the loan. Some lenders will have loan processing fees, some will have insurance and all other costs. It's very important to know the costs related to a specific loan. So it's very important to understand the terms and conditions of loans, the terms and conditions of the interest that the lender is using, and everything that concerns a loan that you're taking. Because if you don't understand these things, at the end of the day, it might be very expensive for you when you're acquiring this loan or the debts. So whether you're borrowing 5,000 from a mobile lender or 5 million for mortgage, understanding the interest model will change your financial future. So don't just look at the monthly repayments. Don't just look at the amount that you're being given. Get to know the maths behind all the calculation that the lender is doing. And if you're not able to understand all that, it's always good to involve a financial expert to help you, because once you engage the services of a financial expert for them to go through your loan terms and conditions and all the calculations, they might save you on some money. So that's it for today's episode. Thank you for joining in. Please subscribe, please like and share. Please ask questions. You can reach me on my email, which is on the description box, and let's keep each other informed. Thank you once again for joining in, and see you in our next one.